Hi, and a very warm welcome to everybody who's joined us for this panel here today at the GSG Global Impact Summit. We're going to focus on the role of capital allocators in driving impact across the African continent. It's a very interesting space to be engaging with, and we've got a great panel assembled here today. We have Alison Klein from the FMO, Michelle Perry from Acrisa, Shailesh Devchand from Old Mutual, and David Moore from Alexander Forbes. And I would like to hand over to each of them and ask them if they could just introduce themselves briefly before we kick off with questions for the panel. So welcome to the panelists, and I'll hand over to you, Michelle. Thank you.
As Paul said, I'm Michelle Perry. I'm based in New York. I work for Axia, which is a research and portfolio advisory firm. We primarily work with institutional investors globally, allocating in alternative space.
Thank you, Paul, for the invitation. I'm Alison Klein. I'm a manager in the private equity department at FMO. FMO is the Dutch development bank. We're actually celebrating our 50th anniversary this year. So for the past 50 years, FMO has been investing structured as a public-private partnership, so partnership between the Dutch state and a number of banks in the Netherlands.
Thanks, Paul. I'm Shailesh Devchand from Old Mutual Limited. I'm a general manager in the insurer's customer solutions environment. And I guess one of my team's key responsibilities or accountabilities is strategic asset allocation and mandate management. We manage a sizable portfolio of with-profit assets.
Thanks, Shailesh. Thanks, Paul. So I look after the alternatives businesses within Alexander Forbes Investments, and Alexander Forbes Investments, by way of introduction, is one of the largest private sector pension fund administrators in South Africa.
Alison, maybe I can kick off with a question for you. The DFIs, development finance institutions, have been significant investors across the African continent for a long period of time, and the FMO has been one of the leading actors in that space. And I think that the involvement of the DFIs has led to, I think, ESG as a practice being quite advanced on the African continent. Compared to where it is practiced globally, where there are possibly less pressures because of the impact the DFIs have had. I don't know whether you would agree with that statement, but maybe you can comment on that and then maybe frame for us how the FMO has sort of anchored its ESG approach. Is it looking at the UN SDGs, for instance, as a cornerstone on which it drives issues, and if so, is it particularly focused on some of those 17 goals, or is it sort of spread across all of them?
Yeah, so I think to start with the question of the role of DFIs and the practice of ESG in Africa, I've worked in the sort of commercial private equity sector and fund investments in Europe before moving to FMO. And there was certainly an emphasis and a growing emphasis on responsible investing coming from our investors when I was working in that private equity asset management space. However, not at the level of granularity and not in such an active hands-on way as the DFIs often are engaged with their partners on ESG in Africa. I think the reasons for that are related to the public funding sources and the reputational risks to which those kind of investors are exposed, as well as their intrinsic commitment to dealing fairly with people and to mitigating any kind of risks or negative impacts that might come along with their financing. And certainly the lack of a sufficiently rigorous regulatory framework and enforcement of regulations around, for example, environmental practices or employment practices has made it imperative to sort of take action as investors to make sure that both the people and the environment are properly treated when investing in Africa and in emerging markets more broadly. You asked a bit about what are those practices and how do we do it? I think partnership is really the term that I would use to describe it as much as possible. coming alongside like-minded investors and partners who are deploying capital on the ground, and looking together at what are the risks that need to be mitigated, as well as the positive impacts that can be had. We are framing some of those today in terms of the Sustainable Development Goals, and I'll come back to that in a minute, but there's actually a relatively new framework for framing impact. And a lot of the ESG, and especially the environmental and social frameworks that we've been using, are structured around the IFC performance standards. The IFC has really taken a leading role in sort of categorizing which are the types of risks that need to be looked into and mitigated when making investments, and particularly around vulnerable people groups, environmental or cultural settings, which might be put at risk by projects or companies. How do we do it? We've got a team of dedicated environmental and social officers, as well as corporate governance officers, who are able to help assess those risks and to help put plans in place to mitigate them when there are risks that should be managed more effectively than they are at the moment of our investment. And again, we really try to take a partnership approach. So on the one hand, assessing in due diligence what's the situation and what risk might emerge, and then coming together with a plan for how to mitigate those going forward.
Shailesh, if I can maybe hand a similar question over to you, which is in terms of looking at ESG across your portfolio, are you using the SDGs to anchor how you look at the world, and maybe just talk a little bit about what framework you might be applying in driving ESG across your portfolio?
Yeah, Paul. I mean, so look, I think we definitely do subscribe to the UN SDGs. I think there are parallels that align quite well to each of those SDGs in terms of the investments we've made in the alternate space. I think our thematic focus, though, has been quite widespread across a range of goals. Climate action being a key priority, and I think, as I mentioned earlier, housing, education, renewable energy and infrastructure are, I think, the core areas where we've found ourselves placing investments over the last decade at least. So if I think about current capital allocations and where we're seeing impact come through, I think current capital is already allocated to many green economy assets. And we're seeing a fair amount of success in investments, for example, in renewable energy. We've got 30 renewable energy plants ranging from wind and, ranging from both wind farms to solar farms. This we do through our Africa Infrastructure Fund. Also significant investments that deliver affordable housing within South Africa. And this also includes student accommodation. So when you talk about the framework, I mean, the framework is, I think, tied in terms of the UN SDGs, the parallels between those SDGs, similar to what Alison has just spoken about, and these very specific investments that we have targeted, making an impact in each of those areas.
Shailesh, thanks very much. That's a great answer there. David, can I ask you to weigh in on the same issue and just give the perspective from Alexander Forbes' point of view? Thanks, David.
Our view is quite similar to both Shailesh and Alison, but in somewhat nuanced in that our ultimate client base are pension fund members. And so we're seeing that, I think personally, my kind of path in the industry was one that I dealt with these same stakeholders over a decade ago, and private markets was much more of a return generator and an alpha provider than potentially an impact generator back then. But now you're finding that members and or boards of trustees in the local context, specifically South African pension funds, are becoming more activist, and they're becoming more interested not only about the return outcome that this asset class can provide, but the social outcome that it can provide for its member base. So it's not about CPI plus 7 or inflation plus a certain outcome. That no longer justifies that this asset class, in their eyes, endears itself to making more than just this commercial return. And so members are asking around when they retire, not to just look at their membership statement around what their kind of total fund credit is, but rather, what did you do with my money? Did you build a school in my local community? Did you build student accommodation like Shailesh mentioned, or did you fund the SME down the road that provides an essential service to keep going, to keep funding and growing the community? So our program that we run is quite generalist in its approach across the SDG framework, but resonates in different manners and forms with different sets of our clients. So certain clients, based on their geographic location, are much more interested in the rural shopping malls we're building in rural parts of KZN and South Africa, whilst others may be more interested in the renewable energy farms that we fund across the country. So it's a little bit more of a generalist view than most, but it's really member driven based on our broad client set that we service.
Maybe, Michelle, I can ask you something slightly different, unless you want to comment on that topic as well. But it might be more interesting from your perspective just to hear around measurement. How do we measure impact? How are you looking at measurements across your client base for impact? And are you seeing sort of trends or perspectives in this regard as to how you would look at assessing the impact metric?
So I guess what I should caveat is that we really focus more on ESG integration, and only a very small subset of our clients are looking at investing directly in impact. We have a lot of interest in renewable funds or sustainable funds, and that's where we've seen clients allocate. Our reporting has focused around ESG integration, responsible investing, collecting data around that. And in terms of when we've seen allocations to impact funds, which has taken place, especially on the private side and the real assets, then it certainly the reporting has focused around the SDGs. Always as kind of a base for some IRIS metrics as well. It seems each player each manager has created their own framework to provide reporting. So there's limited standardization from each of the managers, which is a different challenge if you're reporting across funds to a client when they each have a different way of assessing impact or measuring it.
Michelle, maybe just a follow-up question. Are you seeing, as a consultant in the space, I think you probably are more cited across the space maybe than some of the other panelists.
Totally.
Are you seeing convergence around measurement criteria in the impact space, or is there still quite a differentiated situation out there?
I think there is a lack of consistency, but it's certainly definitely converging. I think it's converging around the SDGs, around IRIS, around IMM. There's definitely it certainly is converging, but we're not at a space here where there's a consistent way of evaluating or reporting on the way that impact is measured. I'm sure Alison could speak more to that, but that's definitely a challenge that we've faced as we try to build out our own impact program internally.
All right, maybe Alison, we can ask you to comment on that, but maybe I can also ask you just to reflect a little bit on what FMO has been doing in the renewable energy space across Africa, and how you frame your intent in that space. What would you see as success sort of 10 years out in terms of the power outcome across Africa? I mean, Africa is a complex situation with 600 million people in sub-Saharan Africa do not have access to electricity at the moment. That's half the number on the planet without access to electricity. So, power in Africa is a profoundly important issue going forward. And I know you, as the FMO, have been very involved in the space around what does the power situation look like going forward. So maybe to comment on the measurement piece, but maybe you might also just want to weigh in on how you're thinking about how power evolves across Africa and your intent in that regard and how you're going to drive things.
Sure, and I think that's actually a nice combination of questions because they actually relate very closely to each other. So on the measurement front, I mentioned that we've sort of chosen these 3 core SDGs that we focus on. So employment is a relatively straightforward thing to measure. At least with a company where you invest, you can find out how many employees do they have at the beginning and throughout the life of the investment. Although with power, for example, you can also make some assumptions to say there's building a project employs a certain number of people for a short time and then a smaller number of people for a long time. But power being available in a market enables all kinds of industries, products and services. So it can contribute to employment indirectly as well. Then we mentioned about climate action. In the past, we've counted greenhouse gas avoidance, and we've also got a label which is green. It's yes or no, but it can also be a portion of green. So if we can underpin that a certain investment is either not contributing to increasing greenhouse gas emissions or is partially avoiding them, it can be sort of a green labeled investment. And reducing inequalities. It's the most recent metric that we've introduced, and really looking at, on the one hand, reducing inequalities between countries, so targeting to invest in the least developed countries on the one hand, but also looking at projects which can contribute to reducing inequalities within a country. So even some of the middle income countries in our target space, South Africa being one of them, suffer from a high level of inequality within the country. And so how can we contribute to sort of leveling the playing field in some sense?
Yeah, I think that's a very exciting space, Alison. I've seen some projections on off-grid power being 25% of power generation in Africa, ultimately, which is obviously, coming from a place like Europe, a remarkable thing to contemplate. But we have seen, of course, in Africa, the extraordinary development of mobile telephony, and it basically, happened without fixed line telephony ever being put in place in a lot of places. And I think the same thing may well happen with power. So I think that's a very good observation.
I think it's a very good analogy, Paul, because when I first started coming to Africa and hearing about this off-grid thing, I thought, well, that's a very limited time opportunity, because as soon as the grid comes to these places, they will no longer want the household and the village level solar generation systems. But if you think, well, why should the grid ever come there? There's no need to put hundreds or thousands of kilometers worth of distribution lines and poles in place to bring it when you can actually generate it locally. It's a completely different mindset, and I think it's really a very compelling opportunity.
Yeah. Shailesh, maybe a question for you. Just the impact of COVID in terms of how you're thinking about allocating capital going forward. Has that modified at all the way that you are looking at where you're committing capital? Do you see areas of better opportunity as a result, or spaces where there can be greater impact leverage as a result of COVID?
I think if anything, we would expect the opportunity set to have increased, especially given the social dislocation we've observed as a result of COVID. And I'd like to believe, actually, that there will be a shift towards meeting that increased demand. And I think overall for us, the shift towards more green economy assets, and in particular driven by the building back better agenda, is something we want to subscribe to. And so that means kind of more investments towards low carbon, socially inclusive investments. And for investors with long-term horizons and outlooks like those within our portfolio, similar to David, many of our clients are pension fund investors. This need not be at the expense of returns. We're quite optimistic on the kind of opportunities that could emerge out of this pandemic. If anything, COVID has also reminded us, I think, of the extent to which our society is quite unequal. and this creates investment opportunities for us to solve.
Michelle, maybe over to you for a slightly different perspective, not so much focused on Africa, but, are you seeing COVID impacting where you feel capital may be allocated going forward? And are there, any consequences for that in what you're seeing your client base up to at the moment?
We're running a survey at the moment with our private clients on if they're going to be changing their capital allocations. And so far, the response doesn't seem to be any shifts in capital allocations. What we are seeing is increased, especially from our European clients, is just increased focus on ESG. Holistically across the portfolio in every asset class, looking to dig in there and seeing what's been done on the private side, real assets, liquid market. So we're seeing increased pressure on that aspect. But we haven't seen a change in terms of shifting capital from their previous priorities because of COVID. We are one of the big challenges I think we're facing in terms of this aspect in the US is that the Department of Labor has announced recently that corporate pension plans should not, or it is not part of their fiduciary duty to consider ESG factors as part of their investment process. And not even when it comes to proxy voting, only financial metrics should be considered. So it's a completely different perspective to direction than the European regulators are taking. Obviously, this is very administration driven. So potentially, with if there's an administration change at the end of this year, we might see a whiplash back to the Obama rules of the time, which were considering ESG as part of your investment process is part of your fiduciary duty. Or the language is obviously soft around this, but basically that was the general direction of it. So I think that's been a headwinds in terms of a lot of our clients. In terms, they said a few clients have said to us, we won't even consider it. We don't even think about ESG impact because we don't want to get in trouble with the DOL. Separately, our public plans, especially on the East and West Coast, are very focused in terms of the climate issues, social issues. If you, if they allocate capital, you have to assert up to 20 different affirmations that you will consider equal rights, civil rights, climate issues, various other social aspects as part of your investment process. And Neil Coleman has allocated $20 billion just to sustainable and renewable investments globally. So I think there's a basket of perspectives, a basket of approaches, and although it's moving towards increased ESG and impact focus, there's also, there's some tailwinds, headwinds that are holding some aspects of this back.
Yeah, it's a complex environment. I know the other thing driving allocations in the US, I think, is the requirement for quite stellar returns going forward, given that many of these large DB funds need to generate returns of 7 to 10% going forward in order to deliver on their liability set. So it's pushing investment strategies accordingly.
Right. Exactly. And I'll just mention one more thing is that we are seeing we've seen some clients specifically interested, I think, to what David said about private credit investing in Africa. So that I think you might see some capital allocated there from some sovereign wealth funds. Are they looking at that area as like a new opportunity, which is interesting.
All right. Maybe in closing, I can ask each of you to weigh in on possibly some personal experience in the ESG or impact investing space that you believe might be useful for the audience, and if not, or in addition to, maybe just comment on the extent to which the S in ESG, the social part of ESG, is something that you're focusing on, and if so, how are you driving that piece? So maybe I can go in reverse order this time, David, if that's acceptable to you, and start off with you, and then kind of close with you, Alison, ultimately. So David, maybe if you're happy to weigh in on that. And if you'd like to issue any other challenge to any of the panelists on the way, then that's also acceptable, I think. So over to you, David.
An example which Shailesh actually touched on within his portfolio is probably the school impetus and the funding of education, which we were quite active in the space, and seeing and having the benefit of pre-lockdown, being able to visit some of the underlying school assets in which we fund through our partners, and see the look on the learners' faces and the quality of the kind of education experience that we were able to assist in providing through mobilizing kind of private sector pension fund capital into these opportunities to create real high quality education assets that are providing education that at a really affordable price that's internationally competitive in terms of its curriculum structure and really giving young lives the opportunity to prosper on the global stage. That's really gratifying to see within a portfolio that is ultimately also targeting commercial return, but it's a sustainable commercial return through structuring and funding initiatives such as that. So, that's an example from my side.
Shailesh, maybe I can ask you to comment.
Look, I won't belabor the point on education more than what I've already said from a social outcome perspective. But starting again at home here in South Africa first, and in Africa actually, I think one of the key challenges is the employment, or rather that of unemployment in the environment, or in our local environment and setting anyway. So this begs the question as to what's actually available out there that is able to deliver in an accelerated fashion the kind of job opportunities that we know the fabric of society needs, firstly, and obviously consequent to that, the impact on the economy it's likely to have. And I guess an obvious avenue for that sort of job creation is infrastructure. I think that's probably also, if I look at some of the debates being had at the industry level and at governmental level, is probably infrastructure is probably the one area which is being considered quite seriously at the moment. But one which I think we're uncovering as we peel the onion, Paul, in terms of our efforts, particularly with regards to climate change, is the intersection between the environmental issues we're trying to solve for within impact investing. So the intersection between that and the social impact that it could potentially have. So, for example, when you talk about things like fossil fuels and maybe coal in particular, in the local environment in South Africa and actually even in Africa more broadly, the number of livelihoods dependent on those sorts of investment, whether it's directly within the mines or through the value chain of fossil fuels across the continent, it itself presents a bit of a dilemma in terms of trying to address the climate change issue as a priority, but at the same time trying to balance that against what a direction there might mean in terms of employment opportunity. And so naturally within the local context, both in South Africa and in Africa, we've got to be thinking about how do we do that in a more responsible way, and in a way that kind of paves a roadmap towards the ultimate objective of avoiding a bigger than 1.5 degree to 2 degree increase in global warming, but being very cognizant of how that approach needs to be nuanced for the specific environment we're in. And so by default, therefore, it may very well mean taking a stepped approach and perhaps moving to the lesser of evils amongst fossil fuels first before a more aggressive type approach.
Shailesh, I think you make a very important point there that a just transition is critical, and being thoughtful about the impact across all communities is very important. Michelle,
I guess one of the challenges that we faced is that as we started reviewing impact and ESG funds was, I think they're called rainbow washing. We were, it's difficult to know, and it goes back to measurement, and reporting is, who's really doing impact well, who's doing ESG well. Just because you have an incredible deck that's got beautiful pictures, trees and children, doesn't mean it has real impact on the ground. And, when you look in the underlying portfolios, you often see investments which don't align with your values or objectives. And so one of the things we've been trying, we'll pass on to our clients is that you really need to dig in, even if the advisory board is, fantastic people and everything, really look at what the investments have been made, because, great marketing doesn't always just, have great impact. So one of the things we've noticed as well is that where managers, they might have incredibly sophisticated ESG teams or, really, as I said, marketing decks, but their fundamental investments or the investment people are not as talented. And in other spaces, we might have a very talented investment team, but weak ESG. So an idea could be to find those naturally occurring ESG strategies like financial inclusion, affordable housing that are being done by non-ESG forward sophisticated managers, and work with them to build that out, or their ESG programs to align their strategies with, with what their potential could be on the ESG or impact side.
Yeah, so there's a lot more we can do. I find it very reassuring and actually a bit inspiring to be on this panel with people who have commercial mandates and find ESG very important. As a development finance institution, it's sort of in our mandate and in our DNA. We cannot do otherwise, but a lot of asset owners and allocators can choose what to do with their capital and whether or not they want to pursue positive impacts or ESG compliant investment opportunities. And I'm really glad that that's gotten so much attention, and that I'm sitting here with all of you who have said we value that and we're seeking it, at least for part of our allocation. And Michelle, you sort of mentioned the dilemma that you are faced with as a fiduciary of other people's capital. And what does that mean? Does it mean you have to maximize financial return? And I think there's a few sort of potential avenues to explore in that. So one is, to what extent does ESG and impact considerations actually potentially enhance your return, or at least mitigate a downside risk? And we have certainly seen some things where things go wrong. If you haven't anticipated the risk properly, it can really severely impact your investment returns. So there's a very important component of risk management in looking properly into, for example, the engagement with the local communities, and are they on board? Are they supportive of your project? Are they potentially going to prevent you from rolling out the project as you've planned it? And then, of course, there's the other side, which if you manage your project in a highly responsible fashion, for example, in the consumer manufacturing kind of business, if you can demonstrate that you've lived up to ISO standards, a certain kind of strategic buyer will be much more likely to feel comfortable acquiring that asset from you when they can sort of tick the boxes, it's being done in the proper way. But I think the other side of it is actually to engage with your investors and to say, are you also willing to do certain things where the ESG and the impact might cost you something? And if you have an explicit mandate from investors, and David, I think you mentioned some of your policyholders, they're asking, what are you doing with my money? And to the extent that you can get mandates where the investor, the asset owner, has explicitly asked you to do something positive with my money, as well as seeking a return, and then you can go back to your regulator and say, yes, I'm a fiduciary, and this is what my client has asked me for, and that's why I'm making the choices that I am. So I think that would actually be my challenge, not specifically to the three of you, but to maybe the audience here. Be clear about what you're looking for, and when you're looking for people to manage your money, be clear. Is impact something that you want? Do you want the ESG to be actively managed? And dare to come up for what you're wishing for.
So, as I mentioned earlier, the impact of COVID in Africa directly has been relatively modest, but African governments as a whole were fiscally constrained before the impact of the pandemic and are not able to support outcomes in their economies to the extent that their Western counterparts are able to do. where, for instance, in the UK, people can be furloughed at 80% of their previous income for 6 months. That kind of thing cannot be done in most African countries. So the impact, the consequences across Africa will be profound from that point of view. We've also seen a collapse in things like tourism, which creates employment prospects for many on the African continent. So in building back, post this COVID impact, I think there's a real role for the private sector to play and private capital in terms of investing in those spaces that can remobilize outcomes across Africa. And I think that the great example of where this has really worked is the South African renewable energy space, where the private sector has invested more than $20 billion in renewable energy projects in South Africa. And it's been a standout program globally in terms of the price point at which renewables have come on stream and the speed with which renewables have been commissioned, to add to the South African grid. And I think we need to look at driving similar programs across similarly deserving areas of investment requirement in terms of assisting these African governments where they're fiscally constrained to put capital to work that will drive good outcomes on reasonable returns going forward, to bring back economies in a post-COVID situation. So I think that's very important. And I think with that, I'd like to thank the panel. It's been a great panel today who've weighed in on this issue as capital allocators and what's happening across Africa. So if I can thank them again. Thank you to Michelle Perry, to Alison Klein, to Shailesh Devchand, and to David Moore. And we look forward to seeing you next year when the conference will be an on-the-ground conference in Africa, in Johannesburg, and not a virtual conference as we've had to live with today. So with that, we look forward to meeting you all next year. Thank you.